Don't mix up the child tax credit with the child and dependent care credit. Totally different credits. For this lesson, think in three buckets: the child tax credit, which is non-refundable, the additional child tax credit, which is the refundable piece, and the $500 credit for other dependents, for dependents who don't meet the child rules. On the EA exam, they love asking which bucket a dependent falls into. Start with, does the dependent qualify for the child tax credit? The big exam triggers are age and the ID number. The child must be under age 17 at the end of the year and must have a social security number valid for employment. ITIN and ATINs don't work for the CTC. Relationship and residency still matter too, but the age 17 cutoff is the classic trap. Here's the money side. The non-refundable child tax credit is up to $2,200 per qualifying child. Non-refundable means it can't reduce tax below zero. If your tax is already zero, the CTC doesn't help. That's where the additional child tax credit comes in. ATC is refundable, up to $1,700 per qualifying child, but you generally need earned income to access it. Phaseouts are mechanical, so test writers love them. The phaseout starts at $200,000 of AGI for most filers and $400,000 for joint returns. Once you're over the threshold, the credit drops by $50 for each $1,000 of AGI over the limit. Translation: take the excess AGI, divide by 1,000, round up to the next whole number, then multiply by $50. If the dependent fails the CTC rules, check the credit for other dependents. That's the $500 ODC. It's for dependents on the return who aren't qualifying children for CTC, like a 17-year-old, a college-age child, or an elderly parent. ODC uses the same $200,000 and $400,000 phase-out thresholds, and the ID rule is looser. An SSN or ITIN can work, as long as it's issued by the due date, including extensions. Mechanically, you report and compute these credits on Schedule 8812. It's doing two jobs: figuring the non-refundable child credit and other dependent credit, and then figuring whether any refundable ACTC is allowed. One more exam favorite: Form 2555. If the taxpayer claims the foreign earned income exclusion on Form 2555, they cannot claim the refundable ACTC, but they can still claim the non-refundable child tax credit if they otherwise qualify. Gordon is 65 and lives with his son and daughter-in-law. He's retired, and his taxable pension income for the year was $12,000. Gordon doesn't plan to file a tax return. Can the son and daughter-in-law claim Gordon as a dependent? The choices include yes, no, because income is too high, yes if Gordon doesn't file, or none of the above. Think about it. The correct answer is no, because his income exceeds the threshold amount. For a qualifying relative, gross income has to be below the dependency threshold. Gordon has $12,000 of taxable pension income, so he fails that test. The tempting wrong answer is the one that focuses on whether Gordon files a return. Filing status doesn't fix the gross income test. For a taxpayer to claim the child tax credit, the child must have an SSN that's valid for employment and issued before when? Your options include at birth, by the end of the tax year, by the due date including extensions, or by the due date not including extensions. Think about it. The correct answer is by the due date of the return, including extensions. That's a favorite EA exam detail. A common trap is picking by the end of the tax year, because lots of tax rules use year-end cutoffs. But for the CTC SSN requirement, it's tied to the return due date and extensions count.